Hello students, my name is Shesi George, your professional accounting teacher. Please, before you continue with this video, try to subscribe to my YouTube channel. Thanks. Alright, let's get started. In this video, we are going to solve this case study concerning the computation of net present value. Alright, so I want you to pause the video and read through the question. Pause the video and read through the question. Okay, now like I always advise, you start with the requirements. Now look at the required. Calculate the expected net present value of the project, which then B part says that which of the projects will be more profitable. Which of the projects will be more profitable? Okay, so we have to calculate the net present value. That is A part. Now, let us go through the case study. Gasikia Nigeria Limited is considering whether or not to invest in any of these two projects, where the initial investment will be 13 million for project A, and for project B is 14 million. That is these are the costs of the two projects respectively. Okay, cost of the projects, and that is outflow. All right, now the project will have 5 years life. That is the lifespan of the project, and the estimated annual cash flow as follows. So you have been given the estimated annual cash flows. This is cash inflow and this is outflow for project A. For project B, the inflow and outflow also is being given. Then the company's cost of capital is 10%. All right, now this aspect is very, very important. This is cash flow with expected value. All right, the concept of expected value, that is uncertainty. Cash flow with uncertainty, that is a capital budgeting with uncertainty. Okay, so the estimated cash flow are considered fairly reliable. However, the estimate of cash inflow are much more uncertain. All right, are much more uncertain. Several factors who made the annual cash flow higher or lower than expected. All right, factor one is there is a 20% probability that government measures to control industry will reduce annual inflow. Then the probability, 30% probability that another competitor will enter the market. Then the impact is that this will reduce the inflow by 10%. Okay, it will reduce the inflow by 10%. All right, then for this there is 40% probability that demand will be stronger than expected. The company will not able to supply more products to the market, but it will be able to sell at a price, at higher prices rather, and cash inflow will be 5% higher than the estimates. All right, now these are the factors to be considered. So we are not certain about the inflow because of these factors. Take note of that. Because of these factors, we are not certain. Like this now, they said we are not certain, but there is probability that government measures to control the industry will reduce our inflow by 25%. So if the inflow is 1, it will be reduced by 1 minus what? 25 all over 100, which is 1 minus 0.25. Okay, and also if this occurs, what do you have is 30%. The inflow is 1 minus 0.1. Are you with me? Then here it will be 1 plus 0.5. That is, the inflow will be 5% higher than the estimates. So take note of all these three measures. But we have been given the probability. We are not certain. So we need to combine these three factors in our computation as follows. Now, you will start with the name of the business, okay, which is Gasikia. Then we have preliminary calculations. So your preliminary calculations, we are going to write, okay, you write computation of joint probabilities. Are you with me? All right. Now, we will start with factor 1, factor 2, and factor 3. Okay. Now, let us look at factor 1. Let us assume that, number 1, let's assume that factor 1 will affect the inflow. That is, it will affect. Factor 2 will also affect. Factor 3 will also affect. Now, what is the probabilities? So we have our workings. We have our workings. So what is the probability that factor 1 will affect our workings? Sorry, our inflow. And that is, let's check. The probability that it will affect factor 1 is 20%. Factor 2 is 30%. And factor 3 is 40%. Okay? So we have 0.2, 20%. And factor 2, 0.3 multiply means and 0.4. Okay? And the joint probability, and this will give you, when you multiply this from your calculator, you are going to have 0.24. So when you multiply this, okay? Now, let's look at the second scenario. Let us assume that factor 1 will affect, factor 2 will affect, but factor 3 will not affect. Okay? And that is factor 1 will affect, that is the probability that it will affect, 0.2 multiplied by 0.3. But for this will not affect, that is the complement of probability. So the complement of probability will be 1 minus the probability minus the event will occur. 1 minus 0.4, and that will give you 0.6. Okay, and this will be multiplied by 0.6, and that is what we call the complement of probability. So when you multiply all this, and this will give you 0.036. Okay, then you will look at another scenario. The other scenario says, supposing factor 1 will affect our inflow, factor 2 will not affect it, factor 3 will not affect it. Okay, so the probability that factor 1 will affect it is 0.2. Then the probability that it will not be affected by factor 2 is the complement of this probability, which is multiplied by 0.7. That is 1 minus 0.3, which is 0.7. Okay, class? Then multiply by the complement of this, and which is 0.6. And when you multiply this, we have 0.084. When you multiply these together, press your calculator to confirm. Then 4. Let's assume that all the factors will not be affected by that the inflow will not be affected by all the factors. If it is not going to be affected by all the factors, we have it's not going to be affected by all the factors. Are you with me? It's not going to be affected by all the factors. It means we are going to take the complement of the probability that will affect. For this will be 0.8, okay, multiplied by 0.7, multiplied by 0.6. So 0.8, that is 1 minus 0.2, which is 0.8. Okay, so we continue like that. And when you multiply this, it's going to be 0.336. All right, use your calculator to do that. Then since don't forget, we are looking at the uncertainty, and it has to do with the probability. All right, when you know the probability, of the occurrence. That is uncertainty. That's what we mean by uncertainty, when you know the probability of the occurrence. Okay, so let's assume that factor 1 will not affect our inflow, and also factor 2 will not affect our inflow, but factor 3 will affect the inflow. So we are going to take the complements that it will not affect. It will be 0.8. It will affect it will be 0.2. It will not affect it. It will not affect it will be 0.8. Okay. Then for this is it will not affect it by factor 2 will be 0.7 multiplied by it will affect it will be 0.4, and that gives us 0. When you multiply that as 2, 4, then okay, then we have, for let's assume that factor 1 will not affect it. Factor 2, it will be affected by factor 2. It will be affected by factor 3. So we take the complement of this. You now take the probability, which is multiplied by 0.3, multiplied by 0.4. And when you multiply this, what do you have? We have 0.096. All right. Now let's look at another scenario. Another scenario says that it will be affected by factor 1, but let's assume it will not be affected by factor 2, but it will be affected by factor 3. So we take the probability of this, multiply by the complement, okay, that it will not be affected. It will be the complement of this probability, which is 0.7, multiplied by factor 3, okay, which is 0.4. I think we have one more possibilities, okay, that it will not be affected by factor 1, but it will be affected by factor 2, okay, then it will not be affected by factor 3. Of course, we have 0.8, that's the complement, multiplied by 0.3, multiplied by 0.6, which is it will not be affected by factor 3. So when you multiply all these out, we have 0.144, and this is 0.144. Then this will give us 0.056. Okay, 0.056. So when you add this, it must give you 1. Take your calculator and add. We have 1.00. Okay, so we have been able to get all the factors. All right, all the joint probabilities. So this is the joint probabilities of the occurrence. Now our working note 2. So we have the joint probabilities. Okay, then we have the impacts on inflow. So you write impact on inflow, then we have the result, then the final value. That's the final expected value. Okay, so we have the expected value. All right, now let's get started. Now what is the probability? So looking at your calculations, you just repeat all this here. Okay, so let's do that quickly. All right, then the impacts on inflow, we assume that the inflow is 1. Okay, when you assume that the inflow is 1, then we said, supposing the first factor, it is affected by the first factor, and it is also affected by the second factor, and it's also affected by the third factor. So if it is affected by the first factor, it will be reduced by 0.25, okay, minus by the second factor, it will also be reduced by 0.10. Then it will also be added by 0.5, and the answer to this is 0.70. okay. If you look at the second scenario, okay, if you look at the second scenario, are you with me? It is affected by the first factor, then the cash flow is reduced by this. Are you with me? So from our analysis here, it is affected by the first factor. It is also affected. The assumption is that it will be affected by the second factor, but it will not be affected by the third factor. So what do you have? It will increase. If it is affected by the first factor, it will increase by this minus by the second factor, but not by the third factor. Okay, so it means the inflow will remain as it is. So when you subtract, you are going to have 0.65. okay, class. Then if you consider the third scenario says that it will be affected by the first factor but not by the second factor. That's why we have their complements. Okay, so if it is affected by the first factor, we only have the inflow minus 0.25, and that gives 0.75. okay, are you with me, class? All right, now when you consider the fourth factor, that is, it will not be affected by the first factor, by the second factor, and the last factor. Okay, and that's 1.0, and that will give us 1.0. all right, then let's consider the fifth scenario. Okay, the fifth scenario says it will not be affected by the first factor, it will not be affected by the second factor, but it will be affected by the third factor. And what do you have? 1.0 minus, it will not be affected by the first factor, it will not be affected by the second factor, but it will be affected by the third factor. That is, if it is affected by, it means it will be increased by 0.05. okay, sorry, this is 0.05, this is 0.05. okay, and that will give us 1.05. don't forget that is 5% is 0.05. sorry for that. Then when you look at the sixth scenario, it will not be affected by, let's assume that it will not be affected by the first factor, but it will be affected by the second factor and the third factor. So it will be 1 minus by the second factor, and that second factor is 0.10, then plus 0.05, and that will give you 0.95. okay, then let's look at the seventh scenario, which is it will be affected by the first factor, not by the second factor, but by the third factor. We are not certain. Okay, so 1 minus 0.25 plus 0.05, and this will give you 0.80. all right, 80. Then lastly, it will not be affected by the first factor, but by the second factor, and not by the third factor. So we have 1 minus what? is 0.1010, and that will give you 0.90. All right. So when you multiply, let's say this is A and this is B. Okay. So our expected value now will be A multiplied by B. Are you with me? And that's when you multiply, this will give you 0.0165. 6 for my calculator is 68. So when you multiply this with this, is that taking? It will give you 0.0234. You continue in that manner, then you add all these together, then the final figure for the expected value is 0.9400. Okay. All right. Now look at these two workings. Now we can now apply it on our inflow. So this is what we are going to apply on the inflow. So all we need to do is to go back to the question